Hey pals, welcome to the 6th episode of Trading with Indicators. I hope you have spent sufficient time on watching and practicing what the previous sessions were discussed. If not, I want to ask you to pause this video, move back to the previous sessions of this course, and then continue watching this session. Otherwise, what am I going to discuss in this session might be a little bit confusing and vague for you. Alright, before going to have a review, please like this video and subscribe our channel if you haven't for more free courses by Crypto Whales Academy. Last session, we discussed about MACD, how to apply it on the chart, and what types of information can it provide us, and the technique of using crossovers to estimate a future trend of the market. Please note that I use the term estimate because there is no certainty in this market, let alone the indicators. In the first session, we thoroughly talked about the functionality of indicators and then that they cannot be the only way of analysis, but they can be used to confirm the validity of your earlier analysis. Let's get back to MACD. In addition to crossovers we have talked about, there are two major points that you should know about MACD, one of which is divergence. If you have come to the thought that the divergence I'll talk about is same with the divergence we mentioned in RSI, you're totally right about that. When MACD forms highs or lows that exceed the corresponding highs and lows on the price, it's called a divergence. We have bullish and bearish divergence here as well. Let's move to my screen to see the difference. Alright, let me show you an example of bullish divergence in MACD as I have prepared one for you already. In this part, you can see the price has descended. As you can see, I have drawn a yellow line which shows lower lows. But if we come to the MACD section and pay attention to the same area starting from here until here, in the same area that the price has descended, MACD says total different thing. At the same period, MACD submitted higher lows. This is called a bullish divergence, after which the price tends to be bullish, as you can see, and ascend. Some traders will look for bullish divergences even when the long-term trend is negative because they can signal a change in the trend, although this technique is less reliable. Now, let's search for a bearish divergence of MACD and let's find it on another chart. For example, let's go to Ethereum's chart. Alright, now we are in Ethereum's chart and our time frame is 4 hours. In order to find the bearish divergence, I want to zoom this out as I have seen one earlier in these parts. Yeah, I think I just found it. Here you go. Let's zoom this out for you. Perfect. I think it's totally obvious now. If we pay attention to the chart, the price has submitted higher highs. It means it was bullish. But if we pay attention to the same period and the trend of MACD, we can see that MACD actually submitted lower highs, which shows a bearish divergence of MACD. It means the trend of MACD doesn't correspond with the trend of the price. A bearish divergence that appears during a long-term bearish trend is considered as a confirmation that the trend is likely to continue. You can see that generally we are in the middle of a bearish trend, and we saw this here. You can see that the trend is totally bearish. Then we saw this divergence and the trend continued to be bearish again. Some traders will watch for bearish divergences during long-term bullish trends because they can signal weakness in the trend. However, it's not that much reliable as a bearish divergence during a bearish trend. Let me show you this as an example. If we come a little bit forward, yeah, here you can see that the overall trend is positive and the price has been submitting higher lows one after the other. But if you pay attention to the trend of MACD, we can see that in the same period, we have lower highs in MACD trend. Although the price continued to ascend, the MACD has submitted lower highs. For this reason, I myself do not trust a bearish divergence in a bullish trend, and similarly, a bullish divergence in a bearish market. In order to get use of divergences and be able to notice them easily on the chart, the only thing that you need to do is to practice frequently. I don't say practice 4 hours today and tomorrow don't even sit behind the chart. You have to make it a daily progress and start training every day. There your success is guaranteed. According to the reports, our students in Market Touch course who have been practicing daily has gotten better results than the ones who just watched a session in 1 day and the other session after 4 days. It's clear that the result won't be satisfactory. Alright, anyway, I'm sure you promised yourself to practice what am I going to teach you daily. In addition to divergences, we have another topic in MACD called rapid rise and falls. When your blue line, or by default we call it a MACD line, pulls away from the orange line or signal line, we can claim a rapid rise or fall is occurred. This is considered a signal that an asset is being overbought or oversold, two of the familiar subjects we covered in RSI. I know, it's time to move to my screen to make it more tangible. In order to understand rapid rise and falls better, first of all, let me add RSI to my chart so that it would be much more perceivable for you guys. So I go to the indicators section and I choose relative strength index. So the RSI is added to my chart. If I zoom in a little bit on the chart, you can see that first of all, my screen is divided to 3 parts. The upper part contains the chart with the candlesticks. The middle part is included the MACD, as we have talked about, and the lower part of my screen includes RSI that we have covered in last sessions. All right, in RSI, we said when the purple line exceeds 70, it's called the overbought. Now we want to have a confirmation of my analysis to check whether it is really overbought or there is a flaw in my analysis. Coming up to the MACD here, we can see before this rise, the blue line was actually dancing near the orange line. But the gap here is formed between the two lines. And we can see that the price had dramatic increase. If we move a little bit forward, we can see another example here. You can see the price ascended and the RSI entered to the overbought area. Similarly, MACD line pulled away from the signal line and composed a summit here. These two examples show that the price ascended excessively, and obviously it's going to descend and get closer to the middle or zero line in MACD. In other words, rapid rises give you a short-term short signals. Conversely, when the price enters to an oversold area in RSI and the same gap is formed in MACD, we call it a rapid fall. Here is the best example for rapid fall. It is totally evident that the price descended dramatically, and we can see, a huge shadow. Let me remove that for you. When we come to the RSI part, we can see that the RSI entered to the oversold area. Meanwhile, MACD confirms that it's a rapid fall as the two lines has gotten separated from each other. This can be a short-term buy signal as well. Please pay excessive attention that we cannot call all of these gaps as signals. Let me show you an example. Actually, these are exceptions, you see. For example, I actually circled it for you. 1 second, yeah. As you can see here, MACD and the signal lines are detached in this area. But RSI lines doesn't confirm that, and that might be risky. So we do not recommend entering or opening a position here. Or let's see another example a little bit backward. we can see MACD forms a weak rapid rise, but the RSI line actually doesn't show that. Even though the price made a quick correction, the position here won't have a good risk or reward ratio. And we learned that we shouldn't enter risky positions in Crypto Whales Academy. So it's better to ignore that. We have come to the end of MACD sessions. Let's conclude what we have told in these two sessions. We covered that moving average convergence divergence, abbreviated into MACD, is composed of two moving averages called MACD line, colored in blue, and a signal line colored in orange by default, and the histogram. Traders use MACD to identify changes in the direction or strength of an asset's price trend. Fundamentally, MACD helps traders detect when the recent momentum in an asset's price may signal a change in its underlying trend. This can help traders decide when to enter, add to, or exit a position. We covered crossovers and their meaning in different occasions and the signals that crossovers can give to the trader. In this session, we covered bullish and bearish divergences and how can they help the trader to estimate the upcoming or the strength of the current trend. And finally, we explained rapid rise and falls in MACD as we combined it with RSI and the signals they can give to us. I hardly believe any free course that covered these aspects of indicators in the way that the Academy provided you and how gradually you are becoming a professional trader. Note that to convert a professional trader to a senior one thing matters, and that is experience and practice. So until the next session, I want you to move to the chart and practice everything we said one by one. Absolutely some questions will come up, and the comment section is yours. We'll respond to your questions below ASAP. If you haven't subscribed our channel, press that button there to be notified about the next free sessions that will be uploaded in a couple of days. See you soon, guys. Trade bravely.